Bond Bonanza. Unraveling the secrets of different bond types, credit ratings, and duration. Welcome to Finance Supergirl, your trusted source for insightful financial knowledge. In this episode, we embark on a journey through the fascinating world of bonds. Bonds play a vital role in investment portfolios, offering fixed income and a range of risk and return profiles. Join us as we explore the different types of bonds, delve into credit ratings, and uncover the concept of duration. Whether you're a seasoned investor or just getting started, this episode will equip you with valuable information to navigate the bond market with confidence. Let's begin our exploration by understanding the basics of bonds. Section 1. Bond Basics. Bonds are debt instruments issued by governments, corporations, and municipalities to raise capital. They pay periodic interest payments, known as coupon payments, and return the principal amount at maturity. Let's take a closer look at the different types of bonds and their unique features. Government bonds. Government bonds are issued by national governments to fund public spending and finance infrastructure projects. They are considered low-risk investments and are often backed by the government's ability to tax and print currency. Examples include treasury bonds and treasury bills. Corporate bonds. Corporate bonds are issued by companies to raise capital for various purposes, such as expansion or debt refinancing. They offer higher yields than government bonds but come with varying levels of credit risk. Credit ratings play a crucial role in evaluating the creditworthiness of corporate bonds. Municipal bonds. Municipal bonds, also known as munis, are issued by state and local governments to finance public projects like schools, roads, and utilities. They can provide tax advantages to investors, such as tax-exempt interest income. Section 2. Credit ratings demystified. Credit ratings help investors assess the creditworthiness of bond issuers. Ratings agencies, such as Standard & Poor's, Moody's, and Fitch, assign ratings based on the issuer's ability to repay debt and meet interest payments. Let's dive into the world of credit ratings and explore how they impact bond investing. Investment-grade bonds typically have ratings ranging from BBB to AAA, indicating a lower risk of default. However, it's important to note that different credit rating agencies may assign slightly different ratings. On the other hand, high-yield or junk bonds have ratings below BBB, implying a higher risk but offering higher yields. It's important to consider credit ratings when making investment decisions. Section 3. Understanding bond duration. Bond duration measures the sensitivity of a bond's price to changes in interest rates. It helps investors assess the potential impact of interest rate movements on their bond investments. Let's uncover the concept of duration and its significance. Bonds with longer durations are more sensitive to interest rate changes, while bonds with shorter durations are less affected. Understanding duration can help investors manage interest rate risk and align their investment strategies accordingly. Section 4. Exploring bond yield and risk-reward trade-off. Bond yields represent the return generated by a bond relative to its price. They reflect market conditions, credit risk, and interest rate expectations. Let's explore the relationship between bond yields and risk-reward trade-off. High-yield bonds offer higher yields but come with increased credit risk. Investment-grade bonds provide a balance between risk and return. It's essential to evaluate your risk tolerance and investment objectives when considering different bond yields. Section 5. Case studies and examples. To bring these concepts to life, let's examine some case studies and examples of different types of bonds. We'll analyze their features, credit ratings, and potential returns to illustrate how bond investments can vary. For example, let's consider a government bond issued by country X with a AAA credit rating and a 5% yield. We'll compare it to a corporate bond issued by company Y with a BBB rating and a 7% yield. This bond carries a BBB credit rating, which signifies a moderate level of creditworthiness. This suggests that company Y has a higher risk of default compared to country X. However, the increased yield is provided to compensate investors for the additional risk associated with the corporate bond. By understanding the characteristics and risks associated with each bond, investors can make informed decisions based on their risk appetite and investment goals. Section 6. Bonds in your portfolio. Bonds play a crucial role in a well-diversified investment portfolio. They provide stability, income, and potential risk mitigation. Let's explore how bonds fit into your overall investment strategy. Bonds act as a counterbalance to equities, offering a more conservative investment option. They provide income and serve as a cushion during market downturns. By including bonds in your portfolio, you can achieve a balance between risk and reward. Depending on your investment goals and risk tolerance, you can allocate a portion of your portfolio to different types of bonds. Government bonds offer stability, while corporate bonds offer higher yields but come with additional risk. Municipal bonds provide tax advantages for certain investors. Conclusion and key takeaways. As we conclude this enlightening episode, it's important to remember the key takeaways. Bonds are debt instruments issued by governments, corporations, and municipalities to raise capital. Different types of bonds include government bonds, corporate bonds, and municipal bonds, each with its unique features. Credit ratings help assess the creditworthiness of bond issuers, and duration measures a bond's sensitivity to interest rate changes. Bond yields reflect the risk-reward trade-off, with high-yield bonds offering higher returns but increased credit risk. Including bonds in your investment portfolio provides stability, income, and risk diversification. By understanding the intricacies of bonds, credit ratings, and duration, you can make informed investment decisions and build a resilient portfolio. Thank you for joining us today on Finance Supergirl. If you found this episode insightful, be sure to give it a thumbs up and subscribe to our channel for more valuable financial content. Remember, knowledge is power, so keep expanding your financial wisdom. Until next time, stay financially supercharged.